It never begins with panic. There is no sudden crash, no breaking headline that instantly changes everything. Instead, it starts quietly, almost invisibly, beneath the surface of everyday life. A home sits on the market just a little longer than expected. A seller lowers their price, not dramatically, but enough to signal flexibility. A buyer hesitates, waits, and then walks away. At first, these moments seem isolated, harmless even. But they are not. They are the early signals of something slower, deeper, and far more consequential, a gradual unraveling of housing value that doesn't announce itself with chaos, but with silence. In previous housing downturns, the warning signs were louder. In the years leading up to the 2008 financial crisis, speculation was obvious. Prices soared rapidly, lending standards collapsed, and demand was artificially inflated. When the crash came, it was violent and unmistakable. This time feels different. There is no single breaking point, no universal collapse unfolding at once. Instead, what we are witnessing is something more uneven, more selective. Certain cities, once considered stable, even desirable, are beginning to show signs of fatigue, not a collapse, but a slow erosion. And that distinction matters. Because slow declines are harder to recognize, harder to react to, and often more damaging over time. In many of these cities, the peak has already passed, but almost no one is saying it out loud. The data, however, tells a quieter story. Home values are no longer climbing. In some areas, they have flattened. In others, they are slipping month by month, listing by listing. Sellers are adjusting expectations. Buyers are gaining leverage, and the balance that once favored rapid price growth is beginning to tilt. It doesn't look like a crisis. It looks like normal. That is what makes it dangerous. Because when a market declines slowly, it gives the illusion of stability. It allows participants to believe that what they are seeing is temporary, seasonal, or insignificant, a minor correction, a pause before the next rise. But history suggests otherwise. Slow declines tend to persist longer than sharp crashes. They drain momentum from the market, they shift psychology, and once confidence begins to fade, it rarely returns quickly. The change begins with demand. For years, demand was relentless. Low interest rates, demographic pressure, and shifting lifestyle preferences pushed buyers into the market at unprecedented levels. Homes sold quickly, often above asking price. Competition was intense, and hesitation was costly. That environment no longer exists in the same way. Today's buyers are more cautious. Higher borrowing costs have reduced affordability, limiting how much they can spend. Economic uncertainty has made long-term commitments feel riskier, and perhaps most importantly, the urgency that once defined the market is fading. Buyers are no longer afraid of missing out. They are afraid of overpaying. That shift alone changes everything. In a rising market, hesitation leads to loss. In a softening market, patience becomes an advantage. Buyers begin to wait. They compare options. They negotiate harder, and when they don't get the price they want, they simply move on. Sellers, on the other hand, are slower to adjust. Many still anchor their expectations to peak prices. They remember what their neighbor's home sold for a year ago. They list high, hoping the market will meet them there. Sometimes it doesn't. And when it doesn't, the process of adjustment begins. First comes the small price cut, then another. Days on market increase, interest fades. What once would have triggered a bidding war now struggles to attract attention. The listing becomes stale. And in real estate, perception matters. A home that sits too long begins to raise questions. Buyers wonder what's wrong with it. They assume there must be a hidden issue. Even if there isn't, the damage is done. The price must come down again. Multiply this process across hundreds, then thousands of listings, and a pattern emerges. Not a crash, but a gradual recalibration of value. This is how slow declines take hold. Not through sudden shocks, but through accumulated hesitation. Some cities are more vulnerable to this shift than others. During the boom years, certain markets experienced rapid price growth driven by migration, remote work trends, and speculative investment. These cities expanded quickly, often without the underlying economic support to sustain long-term demand. At the time, it didn't seem to matter. Growth was enough. But growth without stability is fragile. As conditions change, these markets are often the first to feel pressure. Demand softens, inventory rises, and the imbalance that once pushed prices upward begins to reverse. The change is subtle at first. More listings appear, but not dramatically. Price reductions increase, but not alarmingly. Sales slow, but not enough to trigger widespread concern. Yet each of these signals points in the same direction. Momentum is fading. And once momentum fades, the market must find a new equilibrium. That process can take months, sometimes years. In the meantime, the narrative lags behind reality. Public perception tends to follow price movements, not precede them. As long as prices haven't fallen significantly, many assume the market is still strong. Headlines reinforce this belief, focusing on averages rather than underlying trends. But averages can be misleading. They smooth out the extremes. They hide the early stages of decline, and by the time they reflect meaningful change, the shift is already well underway. This is why slow collapses often go unnoticed until they are advanced. By the time the data confirms what is happening, the opportunity to react has already passed. For homeowners, this creates a difficult dilemma. Selling early may feel premature, holding may feel safer, but as the market softens, the risk of waiting increases. Each month brings the possibility of lower offers, longer listing times, and greater uncertainty. For buyers, the situation is equally complex. Falling prices can create opportunity, but they also introduce risk. Buying too early in a declining market can lead to immediate losses in value. Waiting too long, however, may mean missing the best deals. Timing becomes everything. And timing, in a slow-moving market, is notoriously difficult. What makes this moment particularly challenging is the lack of clear signals. There is no single indicator that confirms a downturn, no definitive point at which the market shifts from stable to declining. Instead, there is a gradual accumulation of evidence, each piece small on its own, but significant in aggregate. Longer selling times, more frequent price reductions, decreasing buyer competition, rising inventory. Individually, these trends can be explained away. Together, they tell a different story. A story of transition. A market moving from expansion to contraction, not with a crash, but with a slow, steady decline. And within that transition lies the core risk. Because slow declines test patience. They challenge assumptions. And they quietly reshape expectations. In cities where this process is already underway, the effects are becoming harder to ignore. Sellers are adjusting more quickly, buyers are negotiating more aggressively, and the gap between expectation and reality is beginning to close. But not without resistance. Markets rarely move in a straight line. There are pauses, temporary rebounds, moments where it seems the decline has stopped. These moments can be misleading. They create false confidence, encouraging participants to believe the worst is over. Often it is. Instead, these pauses are part of the process, a necessary recalibration before the next phase of decline. Understanding this pattern is essential, because without that understanding, it is easy to misinterpret what is happening. A small price increase does not necessarily signal recovery. A temporary surge in demand does not guarantee stability. And a lack of dramatic headlines does not mean the market is safe. The absence of panic is not the presence of strength. It is simply the nature of a slow collapse. And as this process continues, the gap between perception and reality will narrow. More people will begin to notice. More data will confirm the trend. And what once felt like isolated incidents will be recognized as part of a broader shift. But by then, the market will already be different. The question is not whether this change is happening. It is how far it will go and which cities will feel it the most. Because while the decline may be slow, its impact is anything but small. And in the quiet spaces between headlines and data, the true story of the housing market is already unfolding. The shift does not happen everywhere at once. It moves unevenly, touching certain cities earlier, more noticeably, while others appear unchanged, at least for a while. This uneven pattern creates a false sense of security. If one market remains stable, it becomes easy to assume all markets are stable. But housing has never worked that way. Every city carries its own economic structure, its own demand drivers, its own vulnerabilities. And when conditions tighten, those differences begin to matter more than ever. In the early stages of this slow decline, the first signs tend to appear in places where growth was the fastest. Not necessarily the strongest, just the fastest. These are the cities that experienced sudden surges in demand during the boom years. Migration increased rapidly. Remote work unlocked new geographic flexibility. Buyers, no longer tied to traditional job centers, flooded into markets that once operated at a slower, more predictable pace. Prices responded accordingly. They didn't just rise, they accelerated. And acceleration, while exciting in the moment, often carries risk beneath the surface. Because rapid growth rarely allows time for stability to form. Infrastructure struggles to keep up. Local incomes fail to match rising home values, and much of the demand becomes dependent on conditions that may not last: low interest rates, flexible work arrangements, or investor speculation. When those conditions begin to change, the foundation weakens. At first, the effects are subtle. New listings begin to outnumber buyers, but only slightly. Homes take a bit longer to sell. Sellers, still confident, resist lowering prices too quickly. Transactions continue, but with less intensity. It doesn't feel like a downturn. It feels like a slowdown. But slowdowns, when sustained, become declines. In several of these once high-growth cities, inventory has started to build, not because of a sudden surge in new construction, but because homes are no longer being absorbed at the same pace. The balance shifts quietly. More choices for buyers. More competition for sellers. And with that shift comes pressure. Not immediate, not dramatic, but persistent. A home that might have sold in days now takes weeks. A listing that once attracted multiple offers now receives one, maybe two. Negotiation returns to the process, replacing the urgency that once defined it. And negotiation changes outcomes. Prices begin to reflect not what sellers hope for, but what buyers are willing to pay. That difference is where value begins to slip. In some cities, the causes are tied directly to affordability. As home prices rose over the past several years, they outpaced local wages in many areas. For a time, low borrowing costs masked this imbalance. Monthly payments remained manageable even as prices climbed. But as borrowing costs increased, that equation changed. Suddenly, the same home required a significantly higher monthly payment. Buyers who once qualified no longer could. Others chose to step back, unwilling to stretch their finances further. Demand didn't disappear, but it narrowed. And when demand narrows in a market that was built on expansion, the effects are immediate. Fewer qualified buyers means fewer transactions. Fewer transactions mean more listings sitting unsold, and unsold listings eventually lead to price adjustments. This is not a theory. It is a process that has played out before, though rarely in such a gradual, fragmented way. In other cities, the pressure comes from a different source: overbuilding. During the boom, developers responded to rising demand with increased construction. New housing projects expanded rapidly, particularly in areas where land was available and regulations were more flexible. At the time, it seemed justified. Demand was strong, migration was steady, prices supported continued growth. But construction operates on a delay. Projects that begin during peak demand often complete during changing conditions. By the time new homes reach the market, the environment that justified them may no longer exist. This creates a surplus. Not an overwhelming oversupply, but enough to shift the balance. Buyers now have options, not just among existing homes, but brand new properties competing aggressively for attention. And new homes introduce a new kind of competition. Builders are often more willing to adjust prices, offer incentives, or absorb costs to secure sales. They operate with different constraints than individual sellers. They need to move inventory, maintain cash flow, and justify continued development. So they adapt faster. When builders lower prices or offer concessions, it doesn't just affect their own inventory, it resets expectations across the market. Existing homeowners, who may have listed based on past sales, suddenly find themselves competing with more attractive offers. The pressure spreads. Gradually, then more consistently. In still other cities, the issue is tied to shifting migration patterns. During the height of the housing surge, certain regions saw significant inflows of new residents. These movements were driven by a combination of affordability, lifestyle changes, and the newfound flexibility of remote work. But migration is not static. As economic conditions evolve, so do the reasons people move. Some return to larger job centers, others delay relocation altogether, and some simply choose to stay where they are, waiting for more clarity before making a major decision. When inbound migration slows, demand softens. And in cities that relied heavily on that inflow, the effect is pronounced. Homes that once had a steady stream of interested buyers now face a quieter market. Listings accumulate, price growth stalls, and eventually the direction begins to reverse. Again, not suddenly, but steadily. What connects all of these cities is not a single cause, but a shared outcome. Momentum has slowed. And in housing, momentum is everything. A market moving upward tends to sustain itself. Rising prices attract attention. Attention drives demand. Demand reinforces price growth. It becomes a cycle, one that feeds on confidence as much as fundamentals. But the reverse is also true. When momentum slows, confidence weakens, buyers hesitate, sellers adjust, and the cycle begins to unwind. Slowly at first, then more clearly. One of the more subtle indicators of this shift can be found in pricing strategies. In a strong market, pricing is aggressive. Sellers aim high, expecting competition to push offers even higher. Underpricing becomes a tactic to generate bidding wars. In a softening market, that strategy changes. Sellers begin pricing closer to expected outcomes or even slightly below to attract interest. The goal shifts from maximizing price to securing a sale. This alone signals a change in market psychology. It reflects uncertainty, and uncertainty spreads. Real estate agents begin advising caution. Appraisals become more conservative. Lenders tighten their standards, even slightly. Each adjustment reinforces the others, creating a feedback loop that gradually pulls prices downward. No single action is decisive, but together they shape the trajectory. What makes this period particularly complex is that not all data moves in sync. Some metrics may still appear strong. Average prices might hold steady, supported by a limited number of high-value transactions. Certain neighborhoods may continue to perform well, masking broader weakness. This creates mixed signals, and mixed signals delay recognition. It becomes possible to look at the market and see stability, even as underlying conditions shift. It becomes possible to believe that what is happening is temporary, that normal growth will resume once uncertainty fades. But slow declines rarely reverse quickly. They require a rebuilding of confidence, a rebalancing of supply and demand, and often a reset of expectations. These processes take time. And time in a housing market can be costly. For homeowners who purchased near the peak, the realization may come gradually, first through lower than expected offers, then through extended listing periods, and finally through the acknowledgement that the market they bought into no longer exists in the same form. For investors, the calculation becomes more precise. Returns depend not just on rental income, but on underlying value. When appreciation slows or reverses, the margin for error narrows. Decisions that once seemed safe become more uncertain. And uncertainty changes behavior. Properties that might have been held long-term are reconsidered. New acquisitions are delayed. The flow of investment capital slows, removing another layer of demand from the market. Again, the effect is not immediate, but it is cumulative. Each of these shifts, buyer hesitation, seller adjustment, investor caution, adds to the same outcome. A market that no longer moves with confidence. And without confidence, growth becomes difficult to sustain. Yet even as these changes take hold, the broader narrative often remains optimistic. Headlines focus on resilience, analysts highlight areas of strength, and for a time, both perspectives can be true. Because slow collapses do not eliminate strength overnight. They erode it, piece by piece, transaction by transaction, expectation by expectation, until eventually the difference becomes undeniable. By the time that happens, the cities most affected will already be well into the process. Prices may not have fallen dramatically, but the direction will be clear. The energy that once drove rapid growth will have dissipated. And in its place, a quieter, more cautious market will remain. The kind of market where time matters more than timing, where patience replaces urgency, and where the true extent of the decline is only visible to those willing to look beyond the surface. Because what appears stable from a distance can, up close, reveal a very different story. One not of sudden collapse, but of slow, steady change. And in that change lies the reality that many have yet to fully accept. The market is no longer rising. It is adjusting. And in some cities, that adjustment has only just begun. The numbers change first. But people don't. At least not immediately. In every housing cycle, there is a gap between what the data shows and what people are willing to believe. Prices may stall, listings may sit, negotiations may shift, but perception lags behind reality. And in that gap, decisions are made that often define who benefits and who falls behind. Because a housing market is not driven by numbers alone. It is driven by psychology. At the peak of a rising market, confidence feels justified. Buyers stretch beyond comfort because prices keep climbing. Sellers expect premiums because recent sales support those expectations. Investors expand portfolios because appreciation appears reliable. It all feels rational. Until it is. When the market begins to slow, that confidence doesn't disappear overnight. It fades unevenly, shaped by personal experience, selective data, and the powerful influence of recent memory. A homeowner who saw their property value rise steadily for years does not suddenly believe it is worth less. An investor who benefited from rapid appreciation does not immediately assume that trend has ended. A buyer who missed out during the boom still carries the fear of missing out, even when conditions have changed. This creates resistance, and resistance slows adjustment. Sellers hold firm on pricing even as interest weakens. Buyers hesitate but not fully. Investors wait but remain optimistic. For a time, the market exists in a state of tension, pulled between past expectations and present realities. This tension defines the middle phase of a slow decline. It is not the beginning, where signals are subtle, and it is not the end, where trends are clear. It is the in-between, the period where uncertainty dominates. In this phase, behavior becomes inconsistent. Some sellers adjust quickly, recognizing the shift and pricing accordingly. Their homes sell, often with modest concessions. Others refuse to adapt, holding out for prices that no longer reflect market conditions. Their listings sit, growing stale over time. Buyers, too, are divided. Some see opportunity. They recognize that competition has eased and negotiation has returned. They enter the market with patience, making calculated offers and waiting for favorable terms. Others remain cautious, even hesitant. They question whether prices will fall further. They worry about buying too soon, and so they wait, watching the market from a distance. This division slows activity. Transactions continue, but without the momentum that once defined the market. Volume decreases, each deal takes longer, each decision carries more weight. And in that environment, small shifts in psychology can have outsized effects. A single price reduction can influence nearby listings. A failed sale can change expectations. A prolonged listing can signal weakness. These moments accumulate, and over time, they reshape the narrative. One of the most important psychological shifts in this phase is the transition from urgency to patience. In a rising market, time works against the buyer. Delay often means higher prices, fewer options, and increased competition. Acting quickly becomes essential. In a slowing market, the opposite is true. Time begins to favor the buyer. More listings appear, prices become negotiable, sellers grow more flexible. The advantage shifts, not dramatically, but enough to change behavior. Buyers begin to take their time. They compare properties more carefully, they negotiate more assertively, and crucially, they become willing to walk away. That willingness is powerful, because when buyers walk away, sellers are forced to respond. At first, the response is measured. A small price adjustment, a minor concession, an attempt to meet the market halfway. But if interest does not return, the response becomes more significant. Larger price cuts, greater flexibility, a growing awareness that the market has changed. This is the point where perception begins to align with reality. Not completely, but enough to shift direction. For homeowners who must sell due to relocation, financial pressure, or changing circumstances, this adjustment happens quickly. The need to complete a transaction outweighs the desire to maximize price. They accept the new conditions and move forward. For those who do not need to sell, the process is slower. They withdraw listings, they wait, they hope the market will recover. Sometimes it does, but often the wait becomes longer than expected. And during that time, conditions continue to evolve. Another group facing significant impact during this phase is recent buyers. Those who purchased near the peak of the market entered under very different assumptions. Prices were rising, competition was strong, future appreciation seemed likely. In many cases, they paid a premium. Not out of recklessness, but out of necessity. In a competitive environment, paying above asking price was often the only way to secure a property. Now, as the market softens, those premiums become more visible. Not immediately as losses, but as limitations. Opportunities to refinance diminish, equity growth slows, and in some cases, estimated values begin to fall below purchase prices. This creates a subtle but important shift. Ownership no longer feels like an immediate financial gain. It becomes a longer-term commitment. For most, this is manageable. But for some, particularly those with tight financial margins, it introduces risk. And risk influences behavior. Spending becomes more cautious, decisions are delayed, the broader economic effects begin to ripple outward, connecting the housing market to other areas of financial life. Investors, meanwhile, face a different set of calculations. In a rising market, appreciation often compensates for lower rental yields. The expectation of future value growth supports current investment decisions. In a slowing or declining market, that expectation weakens. Returns must come from income, not appreciation. And when income does not justify the investment, decisions change. Some investors hold, confident in long-term fundamentals. Others reduce exposure. They sell properties, limit new acquisitions, and wait for clearer conditions. This reduction in activity removes another layer of demand from the market, reinforcing the broader trend. Again, not dramatically, but consistently. What makes this phase particularly challenging is that it lacks clarity. There is no single moment that defines the shift, no event that signals a definitive change. Instead, there is a gradual recognition, a growing awareness that the market no longer behaves as it once did. This recognition spreads slowly, through conversations, through experience, through observation. A neighbor's home that takes longer to sell, a friend who accepts a lower offer, an agent who advises a price reduction. Each instance adds to the collective understanding. And eventually, that understanding reaches a tipping point. Confidence, once strong, becomes cautious. Expectations, once high, become realistic. And the market, once driven by momentum, becomes defined by adjustment. It is in this environment that the true nature of a slow collapse becomes visible. Not as a sudden drop in prices, but as a sustained period of recalibration. Values do not fall all at once. They settle, gradually, unevenly, but persistently. Some areas stabilize sooner, supported by stronger fundamentals, diverse economies, stable employment, consistent demand. Others continue to soften, influenced by the factors that drove their initial rise. The divergence becomes more pronounced, and with it, the realization that not all markets recover at the same pace. For those watching closely, the signs are clear. Not in headlines, but in behavior, in the way buyers negotiate, in the way sellers respond, in the way time itself becomes a factor in every transaction. Because in a slow-moving market, time reveals everything. It exposes overpricing. It highlights weak demand. And it forces alignment between expectation and reality. This is where the market stands now in many of these cities. Not in crisis, but in transition. A transition that challenges assumptions, tests patience, and reshapes outcomes. And as this process continues, the focus begins to shift. From understanding what is happening, to anticipating what comes next. Because slow declines do not last forever. They move toward a conclusion. A point where the market finds balance again, at a new level, under new conditions, with new expectations. The path to that point, however, is rarely straightforward. And for those caught in the middle of it, the experience can feel uncertain, even disorienting. But beneath that uncertainty, the direction remains consistent. The market is adjusting, quietly, steadily, and with each passing month, the changes become a little more visible, a little more accepted, and a little harder to ignore. Every market eventually reaches a point of recognition. Not a dramatic turning point, not a single moment that defines the shift, but a gradual acceptance that what once was is no longer. In the context of housing, that realization does not arrive through headlines or sudden drops. It arrives quietly through repeated experience. By the time most people recognize it, the change is already well underway. This is where the market now begins to settle. After the early signals and the psychological tension, after the hesitation and uneven adjustment, a new phase emerges, one defined not by uncertainty, but by clarity. Not optimism, not panic, but realism. Prices, after months of subtle movement, begin to reflect true demand. Not aspirational demand. Not peak market expectations, but actual, current, measurable demand. And that distinction marks the beginning of stabilization. In some cities, this stabilization comes sooner than expected. These are typically places with stronger underlying fundamentals, diverse job markets, consistent population flows, and housing supply that never became excessively inflated. In these areas, the decline, while present, remains contained. Prices adjust, but they do not collapse. Buyers return cautiously at first, then more confidently. Transactions increase, and over time, a new equilibrium forms. Not as high as before, but stable enough to rebuild from. In these cities, the slow collapse becomes a slow reset, a necessary correction that clears excess and restores balance. But not all cities follow this path. In others, the process extends further. The same factors that once drove rapid growth, migration surges, speculative investment, overexpansion, continue to weigh on the market. Demand does not return as quickly. Inventory remains elevated, and prices, instead of stabilizing, continue their gradual descent. Not sharply, but persistently. In these markets, time becomes the defining force. Months pass, then years, with only modest recovery. Sellers adjust expectations downward, buyers remain selective, and the idea of a quick rebound fades. This is where the distinction between a correction and a prolonged decline becomes clear. A correction restores balance. A prolonged decline reshapes the market entirely. The difference lies in resilience. And resilience is not evenly distributed. For homeowners, this final phase brings resolution, but not always relief. Those who adjusted early, who recognized the shift and acted accordingly, often navigate the transition with minimal disruption. They sell at slightly reduced prices, perhaps below peak, but within a manageable range. Those who waited, holding on to past expectations, face a different outcome. Longer listing periods, multiple price reductions, and in some cases, final sale prices that fall significantly below initial targets. The cost of delay becomes visible, not as a sudden loss, but as a series of missed opportunities. For buyers, this phase presents clarity. Uncertainty, while not eliminated, becomes more manageable. Pricing trends are easier to interpret. Negotiation becomes standard, and the fear of overpaying, while still present, is less overwhelming. Opportunities emerge, but they require patience. Because even in stabilization, the market does not move quickly. It rebuilds slowly, transaction by transaction. Confidence returns, but cautiously. Lenders remain measured. Appraisals reflect recent declines, and every decision is influenced by what came before. This is the lingering effect of a slow collapse. It changes behavior long after prices stop falling. Investors, too, adjust to this new reality. The strategies that worked during rapid appreciation, quick acquisitions, short holding periods, reliance on rising values no longer apply in the same way. The focus shifts to fundamentals. Cash flow, location stability, long-term viability. Speculation gives way to calculation. And with that shift, the role of investment in the market evolves. It becomes more selective, more disciplined, and less dominant as a driver of price movement. This change, while subtle, contributes to long-term stability. Because markets driven by fundamentals tend to move more sustainably than those driven by momentum. Yet even as stability begins to form in some areas, the broader landscape remains uneven. Recovery does not happen everywhere at once. Some cities regain balance relatively quickly. Others lag behind. And a few may continue to struggle for extended periods, particularly if the conditions that supported their growth do not return. This divergence becomes one of the defining features of the post-decline market. It challenges the idea of a single national trend. It forces a more localized understanding of housing. And it requires participants, buyers, sellers, investors, to look beyond general narratives and focus on specific conditions. Because in the end, housing is always local. What happens in one city does not dictate what happens in another. And what appears as recovery in one region may still be decline in another. This reality underscores the importance of perspective. A slow collapse is not a single event. It is a process, a sequence of changes that unfold over time, shaped by economics, psychology, and behavior. It begins quietly. It progresses unevenly. And it ends not with a crash, but with acceptance. Acceptance that prices can move in both directions. Acceptance that growth is not guaranteed. Acceptance that markets, like all systems, operate in cycles. For those who understand this, the experience, while challenging, is manageable. They adapt. They adjust expectations. They make decisions based on current realities, not past trends. For those who do not, the process can be more difficult, because clinging to outdated assumptions in a changing market often leads to unfavorable outcomes. This is perhaps the most important lesson of the slow collapse. Not that markets fall, but that they change. And in that change lies both risk and opportunity. The cities that are quietly losing home value today are not all destined for the same future. Some will recover. Some will stabilize at lower levels. And some may take years to regain what was lost. The difference will depend on factors that extend beyond housing itself: economic strength, population trends, policy decisions, and the ability to adapt to new conditions. These forces, while less visible than price charts, ultimately shape the direction of the market. And they do so over time. Slowly, steadily, in much the same way the decline began. By the time the process is complete, the landscape will look familiar, but different. Prices will have adjusted. Expectations will have shifted. And the narrative will have moved on. What was once described as a booming market will be remembered as a cycle. One phase among many. And the slow collapse, which unfolded without urgency or panic, will be recognized for what it truly was. A transition. A quiet, steady movement from one state to another. Not dramatic enough to dominate headlines, but significant enough to reshape outcomes. And for those who paid attention, who looked beyond the surface and recognized the signs early, it will not have been a surprise. It will have been a process, already in motion, already visible, long before it was fully understood.